Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So we had the big inflation report out, markets are selling off. Look at 2022, some of the highest volatility that we've seen in decades. Let's talk about that. Number two, markets rebounded the last month of May, but experienced a lot of downward momentum during the first couple of months. Overall, though, we saw a big flight to bonds after they've experienced their largest drawdown in history in the month of May. And finally, housing market has been red hot in various pockets and regions of the United States for the past couple of years with low interest rates. That may be slowing a little bit here as mortgage rates skyrocket to their highest level in several years. So volatility, we know the volatility index, the VIX, is one common way of looking at it, but take a look at this chart. This is the percentage of days during the year of 2022 that had an intraday high-low range of more than 1%. And you can see 90% of the days so far have experienced that type of volatility. You see since 1982, this is ties for the highest, and this is the highest since back in 2008 and obviously 2002, both in the midst of extreme bear markets that we can't quite say that we're in the midst of right now, but in terms of volatility, a pretty similar type of experience. Now, rates jumped up really high so far in 2022, the fastest momentum that we've seen in decades to the upside. And if you look at overall the drawdown in bonds, 15% drawdown from peak to high for the Bloomberg US Aggregate Bond Index. That's the largest in history. And what we saw in May was as volatility peaked in equities, we finally started to see a little bit of buy the dip mentality. Bonds actually had a relatively good start to the second quarter after that tough first quarter, as investors started to really flock to safety and try to buy that dip here. We've obviously seen during the past week, rates have broken out, especially on the short end of the curve with that lower inflation, but you are starting to see that flight to safety in terms of bonds here recently. Now, the housing market has been red hot, like I mentioned. It could be cooling off just a little bit. And one big reason is you look at the 30-year US fixed mortgage rate up, reached as high as 5.3%, off a little bit down to 5.09% here, likely a push higher as rates have jumped up this week. But longer term, this is the highest level that it's been since 2009. So you're going to obviously start to see some pressure on some of those housing prices. Refinances, not surprisingly, with interest rates extremely low for the past couple of years, you saw mortgage brokers and homeowners continually refinance. We've seen that plummet, partly because everybody's already refinanced in recent years, and obviously interest rates are continuing to rise down to 31%. That's again the lowest level since November of 2008. And of those refinances, interestingly enough, is about 81%, the highest we've seen going back on this chart. Of those refinances are including the cash out refinance. Obviously, many people in Main Street America receive those extra fiscal direct payments. We obviously have the extreme amount of monetary stimulus and interest rates very low. Many investors' net worth and balance sheets have been really, really strong with savings rates near historic highs over the past couple of years. Most of those savings the savings rates have come down. People's income have started to normalize as the direct payments have been spent. We're starting to see people dip into their savings, and we're starting to see the consumer balance sheet perhaps affected by this cash out refinance of mortgages, which is obviously going to decrease the equity and the overall assets of the balance sheet. So something to watch there in terms of home ownership. Now, finally, an interesting story out of Quincy, Florida, an old story, but I just found it interesting to talk about during times when it seems a little rough here. So when times were much more difficult during the Great Depression during the 20s and 30s, there's a good story of a gentleman named Pat Monroe, a banker in Quincy, Florida, a small town in Florida, noticed that people were spending all of their last nickels on bottles of Coca Cola in the midst of the Depression when everything was terrible, right? People were still spending money on Coca Cola. So he thought, I'm going to start buying some of these really cheap shares of this company called Coca Cola that everybody seems to still be loving when everything else is not going well. Turned out to be a pretty good bet. He actually encouraged several members of the community to do the same. Turned out Quincy, Florida had about 67 millionaires from purchasing these Coca Cola shares Eventually became at one point the richest per capita city in the nation because of all this Coca Cola money in the town of Florida. So just remember, sometimes when the days are darkest, there tends to be a lot of opportunities out there in the stock market. And this was a good story from looking back in terms of about 100 years ago from some of those citizens in Quincy. With that, I want to thank everyone for watching, and I'll see you next time.